Thank you so much for being here. It's a pleasure to be in this building at this event. My name is Andrii Degeler. I am going to moderate this panel with a great set of people here. Can we please start with a very quick round of introductions so that we can set the stage and then get to the conversation about the future of finance with DLT, starting from Tracy.
Wonderful. My name is Tracy Lee. I'm the founding partner at Istari Ventures. We are a US-based early-stage venture capital firm. We specialize in investing in blockchain fintech, and we also advise a lot of banks on their digital assets strategies. Really quickly, background. My crypto career started from 6 years ago, joined Coinbase, building the first version of Coinbase Custody. And then later on, I led the product team at Circle, building the payments product using USDC.
That's quite impressive. Thank you. Charles?
Hi everyone, I'm Charles Adams from Nickel Digital. We are an institutional-focused investment manager trading solely digital assets in London. I've been in crypto 11 years for all my sins. Most of the team came over from traditional finance, and I lead all investor-related efforts. Previously, I was head of IR for Mode Global Holdings PLC, which was the first crypto company to IPO on the London Stock Exchange, which was an interesting experience, to say the least.
Oh, that's really people with an interesting background. Why is it called nickel, though?
So well, that's a long story in itself, but long story short, if you add 2% of Bitcoin to a traditional portfolio, your Sharpe and your risk-adjusted performance drastically go up. If you add 2% of nickel to a iron alloy, that's how you get really strong aluminium. So that's came from a commodities trader at Goldman.
That's really interesting. I swear I didn't know this story.
It wasn't planned.
Now, look.
Good morning, everyone. So my name is Luc Falempin. I'm the CEO at Tokeny. What we do is it's an operating system for on-chain finance. So we do this since 2017. I'm in crypto since 2012, something like this, and basically an entrepreneur building software for quite some time, transactional platforms. And today we help financial institutions like asset managers, banks, fund administrators to tokenize their assets in a compliant way, so to issue, manage, and distribute them in a proper way.
So Charles could be your client?
A lot of people could be your clients if they knew exactly what we are doing, because tokenization is not just deploying a smart contract, it's much more than that. It's managing the full life cycle and the distribution. And when you bring compliance and control on public blockchains, you can do a lot of amazing stuff and bring good assets in the crypto rails. And it's much needed, I think.
Nice. How big is the company now?
Not sure it works, right? You can speak louder. We are 42 or 43 people, something like this. Yeah.
Perfect. And you've been around for like 7 years, you said before, right?
Yeah, we started in 2017. When it was the ICO crazy waves. And my first company was in the e-commerce industry, so we basically brought a good UX to this ICO wave, and then step by step we wanted to bring good assets, serious players. So it was long, but now the big players are doing it, want to build their digital asset platforms, so now we are finally helpful.
Right. So it's nice to see that we have 3 speakers with great experience, long experience in the industry. So we should be able to also have some context to what's going on. So you've seen the ups and downs, and you definitely can talk and very much qualified to talk about the future of finance with these technologies. Tracy, can I ask you something? So you've had this experience at Circle and Coinbase Custody that you helped build. So how do you see the role of stablecoins evolving in this ecosystem, let's say over the next 5 years?
Sure. I think, first of all, right, I think stablecoin is literally the best innovation, I believe, come out of the digital assets world, right? Especially for our fund, we are very bullish, specialize in anything to do with moving money on chain. Without stablecoin is nearly impossible in the past, right? So what has been happening since the last, let's say, 10 years? What we have been seeing is there's a new trend of either in the private institutions or on the national level, they are developing their own local currency-backed stablecoin. However, we still feel like the war happening probably in the next 1 to 3 years, even 5, is the US-backed stablecoin are in the rise. We just actually held a crypto payment and DeFi summit last week in Austin Consensus. So we were talking about, how Ethena, I don't know if people are familiar. Ethena is a new synthetic-backed stablecoin. Has been on the rise, having very high yield. It's kind of like a new wave of different ways we're thinking about stablecoin. Wouldn't necessarily think it's a way to go, but there are a lot of innovation in the space, right? Private institutions like Franklin is doing them. Of course, JP Morgan has been for a while. But what we've been seeing is different banks in different regions are trying to launch their own stablecoin as well, right? But there's also evolved with a lot of challenges. Like, for example, PayPal has their own, stablecoin, PYUSD. It hasn't been really taking traction, right? So for what we're seeing is the liquidity part has been the most challenging for a stablecoin. If you build on a private blockchain or associate with a private company, like, why do people want to use it, right? USDC and USDT has been widely adopted. So I think we'll have to see how that is going to pan out in the next several years. I think on the other hand, I'll quickly wrap this up, is on the technology front, I believe there are so many things can be developed or can be innovated, right? So for example, Circle just launched something called CCTP, which allow USDC to easily convert via different blockchains. Right? We have a portfolio company called Moonwell. They do another similar bridging to bring USDC onto different blockchain and providing yield option. Right? So these kind of like new technology never ever existed before. So we're gonna see that being kind of start building out in the next several years.
So this is big part of your focus apparently as VC.
Yeah, absolutely. We are actually known within the US, we're the first venture capitalists focusing in blockchain-based payments and finance.
Right. Do you guys agree that stablecoins are the most important innovation over the past years?
They're definitely been the killer use case of crypto so far. I mean, we've seen over $150 billion cycle into these stablecoins, primarily US dollars. Circle is kind of USDC has been our stablecoin of choice traditionally. I think the interesting thing moving forward is how does these big traditional players getting involved with the space affect people like USDC and Tether. So we've traditionally tried to use USDC as a form of collateral for our trading. Tether has been the stablecoin of choice for most exchanges, which we've reluctantly had to use. Now we're in the process with BlackRock of using BUIDL. So BlackRock has tokenized their money market fund as an Ethereum token, and we'll be moving our collateral over to that. So instead of facing Tether as a counterparty, we'll be facing BlackRock and ultimately the US government. And it'll be interesting to see, at the moment, BUIDL, I think, has a $5 million minimum subscription. So it's not going to be taking over the retail use cases of stablecoins. But that will get cycled down. And sooner or later, will everyone around the world be using a BlackRock stablecoin? Will it be a US government one? We saw Paxos announce, I think it was this week or last week, a yield-bearing stablecoin. So it'll pass that 5% down, regulated in the ADGM. And it's only a matter of time before these yields actually get passed down to the underlying user instead of getting soaked up by Circle and Tether. I don't see Tether making $5 billion net profit a quarter with 40 employees forever.
Luc, what would you say?
So of course, stablecoins are a great use case in the crypto world. It's the best use case. With our clients, we don't see that much adoption with the main stablecoins, USDC, USDT. Financial institutions are not that confident with this type of new form of money. That's why we work a lot with money market funds. All the largest asset managers are tokenizing money market funds to bring cash equivalent or on chain, so something you can play with.
Right. And look, I wanted to ask something to you while we're on it. So, what do you think are the most significant barriers actually to more widespread adoption of tokenized assets? So, like, this is something that you do day in, day out. So, what's it like, and how do you address these challenges?
So for me, the main challenge is really about standardization.
Okay, we have a panel on that in the afternoon.
Yeah, but most of our clients come and they think they have very specific needs. But actually, what you need first is to represent the different stakeholders on the blockchain, represent your asset, and then manage transactions. So it's the same basis for everybody. Or you enforce compliance, etc. It's the same for everybody. And on top of this, you can add other smart contracts, other tools, depending on your assets. But standardization is very, very important. And that's why actually we created this framework. So a few years ago, we are a very small company, so we didn't want to bring this standard to the market. We'll have been very happy to use another one. But over the years, we had to develop one. And last year, we open source everything. It's called the ERC 3643. It's a terrible name because
rolls off the tongue.
Really ERC. And now we even created a non-profit association with 70 members to promote it, continue the development. In this association, we have large law firms, 20 tokenization platforms, blockchain networks, large financial institutions, and we bring everybody around the same table to just say, okay, let's agree on how we work.
And mostly European then at this point?
No. Yesterday we had a call with one of the projects. We had a guy in New Zealand, in Hong Kong, another one in El Salvador, in Toronto. So it's a global association.
Wow, that's really great. And Charles, I also wanted to ask you about the institutional investors that you may be talking to reasonably often, I suppose, right? So what do you think are still the educational and knowledge gaps among them regarding digital assets? And again, how do you address this type of challenge in your work?
So I think the actual trading strategies that we do have come over from traditional finance. So the institutions are comfortable with them. The thing that's really tough to educate on is the counterparties that they face. So there's three major counterparties that you face when kind of trading crypto. You face the exchanges, stablecoins, and custodians. Stablecoins, I think, have gotten into a pretty good shape. You know, if we can use BUIDL or USDC, that's much better than it was 5 years ago. The exchanges traditionally have been a problem. FTX, right, not too long ago. At the moment, we're able to mitigate this risk through off-exchange settlement solutions. So effectively, we post a stablecoin to a custodian, and that gets mirrored to an exchange. Soon, we'll be posting T-bills to a Swiss bank, and that will get mirrored. So the exchange risk is getting mitigated. But the custody risk is one which is ever-present. And I would say 50% of my time speaking to institutions, whether it's family offices, pension funds, and anyone in the middle, is spent on custody and educating people on custody. And I think one of the main things that we can do to kind of move through this is through regulated products. You know, we saw in the 13F filings of the ETFs in the States, the biggest holders of them were the big multi-strat funds. You know, they didn't have to go through extra investment committee meetings and get approval to trade those. They were able to just dive in the space of a month, acquire $2 billion of these Bitcoin ETFs for Millennium Management alone. And that's because they're trading it on a traditional exchange who is kind of taking all of that complexity of the custody of the assets away. I think Coinbase has been the kind of custodian of choice for most of those. But it's still, like the custody issue is still where 50% of my time is spent.
Just a little interesting story, right? Even talking about Coinbase custody. Like 6 years ago, the hedge fund managers that were assigned to be our clients, we literally have to send our people to their office to help them set up a password, get a UB key to teach them how to use that, right? So I think that's a fundamental gap that it's a brand new technology, not just even the regulation.
Better though, hasn't it?
I mean, I hope so. But it's just a challenge, right? Like people live on a different world, right? So how we started back then, even Coinbase custody, is all the people back then working Coinbase, they're the best engineers in the world, and they built the best technologies, which, you know, pretty difficult for a lot of people to adapt. But I will say, in terms of technology, even on custody or adoption, this is a blockchain. It is a technology, regardless. It's gonna take probably several decades for us to get to, let's say, from the beginning of the internet to as of today, right? So it's going to take us literally rounds of technology innovations with a better application, with better use cases, right? Usability. So to me, that's another challenge to seeing why institutions are even not adopting is people don't even know how to use a MetaMask.
Yeah, I mean, I would argue that this technology development has been sped up quite a bit. So it's getting faster and faster, these cycles that you're talking about. But still, of course, it's a question of time.
I mean, the competition in the custody space at the moment is fantastic for us. It's brilliant. You've got Standard Chartered with a custodian, along with Northern Trust and SBI. Nomura have a crypto custodian. State Street acquired one. PayPal acquired one. And that competition will only lead to better solution for institutions.
Right. And then, so Tracy, you've been a VC with the VC for a while, right? So you've seen a whole lot of companies. And what's your sweet spot in terms of stage, ticket? What's it like for you?
We started a fund a little over 2 years ago. It's new. However, because we are the only crypto venture fund are specialized and bullish in the payment space, we've been seeing nearly 80 to 90% of entire ecosystem to us. So we do early stage, means mostly seed stage investments.
Right.
Some Series A, mostly valuation below $100 million. That's our sweet spot. But of course, the lower the better. So in general, for example, we have a few very well-known portfolio companies. One of them is called Transact. They are the direct competitor of MoonPay. We believe they're going to surpass MoonPay very soon. Right. The other portfolio company is called Magic. They provide a easy tool to generate a crypto wallet address in the background.
Right.
They were led by PayPal last year at a $450 million valuation. So typically, we are seeing a lot of use case or application built around cross-border payments, peer-to-peer B2B payments, crypto payouts, payrolls. We're looking at identity or security-related applications. Of course, DeFi is actually one of our biggest use cases. We tend to invest more on the real-world DeFi applications rather than degen DeFi.
Right.
So for example, we have a investment in Colombia. They lend to small business owners with on-chain, right, USDC lending to small business owners where they couldn't get credit locally from their banks. So
Right.
Banco Colombia was actually the lead investor on that investment. So we historically has been co-investing with a lot of banks in different regions. So for example, in Asia, UOB is very active. We've done several deals together. Deutsche Bank here is, well, I just came in from Berlin, but Deutsche Bank is quite active in the space as well, investing. So we have seen a lot of banks are specifically very interested in what we do, right? Because we're the VC, we go out there every day, talk to the founders, and spend time with them.
And it's a very lively landscape, of course. So how would you say your criteria of evaluating these potential deals have changed? And what are these criteria today when you look at the companies coming to you?
So I would say in the beginning, right, when we started off, we do look for founders who personally prefer to have prior crypto building experience, because what we found is a learning curve for building something which you've never worked before is extremely difficult. But throughout kind of like after a year or so, we realized, you know what, we really actually need a founder to have a fundamental founder mentality, right? Because in the past, in the beginning, a lot of them never ever founded a startup before, right? Never be your own boss, doesn't know how to work it. We feel a few founders fail in that case. So now we tend to prioritize more on founders, and not only having a crypto background, plus the best one is plus a financial background, means work for a bank or work for a fintech company, but also have done some startups in the past, either failed or successful, right? These are very, very valuable background. Because what we have seen is some of the founders have pivoted their product, right? One of them, for example, was initially building a better version of Etherscan, right? Have transaction data. Very quickly, they realized they can't make enough money on that. So they're pivoting to build a way better trading insight tooling for a lot of hedge funds, right? That's a bigger market for them. So that's kind of like transitioning, right? We want founder have the fundamental financial background. That's another key we've been seeing, right?
And when assessing the business model itself?
Yeah, typically, right, because the type of investment we do are typically DeFi, right, payments. We've talked to some founders in the US, have building algorithm-based stablecoins, never went to, never have a degree in finance, never worked for financial institutions, right? My partner, who is a 25-year-old trader from Wall Street, literally told me that kid doesn't even deserve to bring coffee to me at my own firm, right? So the early days, you see the DeFi crypto founders are like that, which for us is such a red flag.
Right.
Yeah.
Right. Now I see what you mean. Now, Charles, so you have we can say that Nickel is a success, right? A successful digital asset management company. So can you tell a little bit of basically what brought you there? What were the components to success, and what, especially on the volatile market such as crypto is, what are the main, commandments that you've been adhering to over this time?
So I think there's definitely a couple. One of them builds on exactly what Tracy was talking about. It's this kind of, you need a unique team blend. You need people with traditional financial expertise. You need people with experience building companies. But then you do need people with experience in crypto itself. We do have crypto native developers that the first language they learned was Solidity. And having that expertise when we're doing stuff in the kind of decentralized finance world is second to none. I think another reason is just the importance that we've placed on kind of one, regulation, and two, creating, for lack of a better phrase, a traditional fund. You could come into our office, you could meet everyone. You'd never really know that we trade crypto. The institutions that face us, they face a traditional Cayman feeder fund with USD share classes, with KPMG as an auditor, and doing it kind of how we see the right way, as opposed to perhaps a more crypto native way, is definitely going to be more successful in getting people to dip their toes in the sector. So 80% of our investors, we were the first exposure to the asset class that they got. And I think it's one thing having a crypto native product that you can sell to crypto people. But I think the bigger challenge that's more beneficial for everyone is to build a product to get people into the sector. What's going to be their first touch? It's not going to be, a cross-chain liquidity provision strategy. That's just too much to get your head around as a first step. But someone who's trading a traditional funding rate strategy in crypto, like the big multi-strats are doing between the CME exchange and the ETFs, that's easy to get your head around, and that's going to be a first entry point. So I think there's a couple of points in there, but we definitely hopefully there's more success on the horizon as well.
Right, so a bit of a chameleon digital asset management fund.
Being really boring, like in this space, being really, really boring helps.
We've been told our investment thesis is not sexy.
Okay. Not enough. Look, I wanted to turn to you. So we got it. Tokenization is great as the future of finance. But can you talk a little bit about the functional benefits of it for capital markets? What do you think are these benefits, and how do you actually leverage them to improve market efficiency?
Yeah, so a lot of benefits can come, but most of them will come when everybody uses tokenized assets. That's the reality. So the main benefits are basically to reduce data reconciliation, which is a huge pain for finance. Everybody is doing operations in his own ledger, in his own silo, and then you need to reconcile data all the time. So data reconciliation is disappearing with tokens. That's the first thing. And the other big benefits that nobody's talking about is the real-time feelings that you have when you use tokenized assets. When you use crypto, you click, it's done, it works, boom. With tokenized asset, it's the same. So you don't need to call your banker anymore and wait for 2 weeks, and you never know if it's done or not. No, you click, you trigger the action. Potentially someone will verify, but at least you know exactly where you stand. So there are the two main benefits. And then it depends if you focus on the issuers and their agents, or if you focus on investors. Today, where we bring the most value, it's for issuers and all of their agents. Custodians, fund administrators, etc., because everything is digital, so it's much faster, much easier to operate, so it's cheaper. I'm not saying that the fund admin costs are reducing yet, but it's coming. And more and more we are working on the other side for investors, where we try to bring new utilities. It's becoming more and more easy to collateralize assets, especially in private markets, where today it's impossible, are very complicated. And we bring more and more transferability, and step by step it will bring some liquidity. So for private markets, it can be really useful for investors, but we're not there yet. For the moment, it's mostly making sure that the pipes of finance are much more efficient.
Right, I understand. So we have a couple of minutes left, and I wanted to do a bit of a lightning round with all panelists, something to sum up what's been told already, but also to give some, I don't know, actionable advice to people who are watching it now, who will maybe watch it in a recording of it. So what would be your advice to people, be it entrepreneurs or investors entering this space, digital asset space? What would be the main thing that they should be aware of as they are starting their journey, starting from you, Tracy, and then down?
Sure. I think I'll probably come from this, the Silicon Valley entrepreneur advice. To me, just get into and do it, right? If you've never done it, set up a wallet, ask your friend to do it. If you've never, on a company level, if you want to participate, join some groups, go to some events, talk to people. I've seen that working pretty well, making friends who knows what they're doing. And once you get, so I think it's a technology issue. Once you understand the technology, you're going to see this has a potential that nobody have seen it in the past, especially for banking, for programmable money, right? For me, it's just get into it.
And in my experience, these people are usually quite talkative bunch, so they're always happy to discuss this.
Yeah, I call a lot of my New York friends are dinosaurs working in banking. So for me, it's just, you want to keep up with the innovation, right? Just get into that, whatever group, whatever knowledge thing, right? Events, talk to people.
Right.
See how you feel. Perfect.
Charles, your word of advice?
Focus on the product and speak to clients. Try not to learn everything in the newspapers and the media about what the sector's doing. I think if you focus on a good product and kind of speak to your clients, you'll get there. I think that was one of the most damaging things about FTX was the media attention. Worse stuff has happened in this space, for better or for worse, but that media attention, I think, skewed a lot of people's objectives. But I think if you keep your head down, you engage with the sector, you'll get there.
As a journalist, I feel personally offended. But we didn't report FTX, though. It's not exactly our area. Thank you so much. Luc?
A bit similar, I will say, stop talking about it and start using it and doing things, making things. When you work in the space, you see opportunities every day. I have 100 ideas of business you can start on crypto rails. So just start. Is the same for financial institutions. Is when they start that they realize everything they can do with it. So yeah, let's not be scared about even the degen innovation, etc. It's so amazing.
I've always believed ideas are cheap. Execution is what matters.
Indeed.
Perfect. Brilliant. Thank you so much, Luc, Charles, Tracy. Let's give a big round of applause to our panelists today. Thank you very much.